Hello, this is Dr. Janicito, and this is another video that we are doing for Chapter 12 of our ISU, our ISU prep. And this is particularly helpful if you have your financial statements for the annual report of the company that you're doing. So what we're doing now is we are very close. This is the last video about financial statement analysis. And let me take it right to the end. And we have, let's see, no, that's not it. We already did that. Objective 5. And this is measuring, as I say, measuring the economic value added by the operations. And this is something that investors look at. Sometimes they look at it and they have this raw value. And they say, well, basically, if you're going to invest money, then you want a return, and so the capital charge, if you want maybe 5%, this day and age with interest rates being low. However, if you're investing in maybe a startup company, then you want your capital charge to be a bit higher because the risk is higher, and maybe you're looking at 20%. I mean, that's a little bit high. That's actually very, very high. Maybe 13%, and so that's the amount that you have to calculate, whereas already from the financial statements, you have your net income and plus your interest expense. So you add these together, you subtract the capital charge, and you want basically a positive number, because a positive number basically says your investment has paid off, you've got a higher return. Let's take a look now at, let's see where it is. So net income plus interest expense. You subtracted the capital charge. And the capital charge is, again, fairly easy to calculate. So what you do is you decide what the cost of capital is, and in any homework or any test, we will give you what we think is the capital charge that the investor wants. And so the capital charge is you just add all these together. Your notes payable, and then current maturities of long-term debts. So let's say you've got a mortgage of 10 years, and guess what? It's coming due this year. So you add that, and plus your long-term debt, and then the shareholders' equity, and that could get you the cost of capital. Now, in the sometimes when we give you financial statements, it doesn't contain all of these. Maybe just it contains a few of these. Maybe it contains one of these. And that's up to you to find out what's information that's provided is useful and is applicable. So then you take the capital charge, and then you add these together, and then subtract the capital charge, and as I say, you want a positive value. Now let's take a look at, since we've done all these ratios, and now the financial statement analysis, they don't paint the complete picture. So that's where you have to put on your thinking cap, and you look at trends and see what exactly the information is telling you for you to interpret. So what's interesting, for example, is if there's any earnings problem. Remember, earnings is basically you're looking at net income, and remember the components of net income are revenues or sales, and then you're looking at the expenses. So, for example, we've been looking at Samsung and Apple, and remember we were saying that there's a problem, not a problem, but yes, what we're seeing in, let's see, where is it? This is Samsung. Let me just go back. Samsung, find their income statement. Where is that income statement? Here we go. Oops. Here's the income statement for Samsung. Let me just find it. There it is. I'm just going to have to see if I can get this screen to shift over. So when we see there's some problem with earnings, that's something that we have to pay quite a bit of attention to. So what we have here is Q2 of 2014 compared to Q2 in 2015, and we're noticing here in trillion wons, that was the sales a year ago, and here it is now. There's definitely a decline. So it looks like that there is an earnings problem. If you look here, the net profit, 6.25 trillion won and 5.72. So there's, and then what's happening with cash flow? It's something that you want to pay attention to. Now remember, we looked here at Apple doesn't have much of a cash flow problem. They're swimming in money, and so that's a different situation. But red flags, I mean, it's good to know, like the Apple's sitting on a lot of cash. What are they doing with it? Now we understand they bought, I think, Beats, or is it Beats Note? And so they're doing something with it, which will benefit the shareholders. So Apple doesn't have the problem of too much debt. I believe there are some companies which have too much debt. So remember, debt is obligations you must pay back. It's a liability. It could be current liabilities, or it could be more long-term liabilities. So, are they raising money through debt rather than selling shares of equity? Here's another thing, inability to collect receivables. Let me see if I can find this one. So here we are. It's Samsung, and where is that balance sheet? Yes, balance sheet. So the accounts receivable here in Samsung, I mean, if you look at it, it's quite a big chunk of at their total assets. So almost 10%. Remember, we looked at the example of Apple, which is, I think it was like 6 or 7%. So I mean, that's something that to be aware of. What can Samsung do in order not to have that many receivables, people in the pipeline paying? And then, as they say, build up of inventories. So BlackBerry has a problem of people aren't buying. They're not buying, and they're producing more than the market was willing to purchase. Then it's backed up. And then another thing it's good to look at is, as they say, the trends in the sales. Not just looking at sales, but looking at the trends. This is where your horizontal and vertical analysis, actually more horizontal analysis, comes in. And your trending, remember our example in the book is Vodafone. I mean, it's like it goes up and down, like a ping pong ball. And I believe I read somewhere that the trajectory of Samsung, it seems to be declining with certain sectors, certain markets. It would be nice to know what's happening there. I think Huawei, the Chinese cell phone company, what they're doing is, I think they're churning through their inventory. But is it because their sales are in certain markets? So as you can see from Apple, they sometimes like to break up the numbers according to geographical territory. And then again, trend with receivables. So this is just good information to have. So it's good for information that you can tease out from these ratios. Look at it as in the big picture, rather than 15 ratios. Now let's take a look at, you see this textbook in your chapter 12 doesn't mention the efficient markets hypothesis, but their PowerPoint does. So what I'm going to do is, well, actually I changed the PowerPoint, at least this couple of slides, because I thought, well, if they're going to mention the efficient markets hypothesis, I'm going to bring you up to date. So efficient markets hypothesis really belongs into a finance course rather than an accounting course. But I suppose you can make a case for it being here, in that just because you look at the financial statements, it doesn't mean that that's the financial statements, basically, they tell you some information, and they, along with all the other information out there, marketing reports, etc., everybody has all the information. And basically, you can't beat the market. Everything's out there. Everyone's got the same information at the same time, so you really can't beat the market. This gentleman, Eugene Fama, University of Chicago, he shared the Nobel Prize in 2013 for economics because he championed the efficient markets hypothesis. And he basically, what he says, you'll find it is the backbone of a lot of investing texts. Basically, risk is something you can manage. You can diversify a certain amount of risk, and there's some you can't. But this goes in much more detail in finance course. But yes, risk you can manage it. And one of the best ways to manage risk is don't put all your eggs in one basket. You want to have a diversified set of securities inside your investment or retirement portfolio. And rather than pick and choose, different stocks and actively watching the market, you might as well just go for mutual fund. But if you want to minimize costs, then maybe you want to go to electronically traded funds in order to basically you want to buy the market. You can't beat the market, so you might as well just go with it. ETF or mutual fund which buys the market and everything is fine. Okay, that's the efficient markets hypothesis. Now, that your textbook doesn't go into it. It was published in 2014, and the Nobel Prize came out, I think, in the fall. It didn't make the printing, but I want to talk to you about my opinion about the efficient markets theory, and it's basically my opinion is really because the other co-winner of the Nobel Prize for Economics in 2013 was Professor Robert Shiller in Yale. And he says, well, it'd be nice if everybody got all the information at the same time and everybody acted on the information in the same manner. But he plowed through lots of data. He says, you know what? People are influenced by other factors besides the same information at the same time. They look at what everybody else is doing, and then there's psychological factors. And he basically pioneered this whole area study called behavioral finance, and at Yale. He's profoundly important, and he's written a book called Irrational Exuberance, and it's now in its 3rd edition. And Professor Shiller, actually, there's a course on finance that is online at Yale. It's an excellent course. He's just a very profound fellow who's very humble, very easy to understand. He speaks in a particular American mannerism that for some people may take some getting used to, but it's a pleasure for me to actually learn from Professor Shiller. And so he predicted the tech bust in 2001, and then he also predicted the housing market going bust in the U.S. in 2007, 2008. So, anyways, this is, I guess, a sneak preview for finance. Your textbook, there were some little things that, as they are in the PowerPoints that are in your text, but what can I say? A little bit of knowledge doesn't hurt. So thank you very much. This is the end of Chapter 12. Chapter 12, remember, is something that we've been looking at for several PowerPoint videos because it relates to understand the financial statements of the company you're studying. So I hope you have been downloading the financial statements from the annual report. You've been following along with our videos, and I wish you very, very good luck in the ISU, which is due at the middle of November. And remember, you're going to present on it too. So thank you for your attention, and looking forward to seeing you in class. Take care. Bye-bye. Oh, and actually, since we are at the end of Chapter 12, we'll be having our chapter test, and so there's going to be some homework assignments that are assigned, and to help you consolidate your learning of this chapter. And so please do your homework, follow along, big pieces of paper, and don't bring a pen, use pencil, highlighters, and I look forward to concluding this chapter. Take care, bye-bye.